Hello viewers, I am Prerna Agarwal from Group 9 and my team members are Rajat Sharma, Keshav Gupta, Sakshi Mirani and Ratnakar Gaur. This video would be explaining the two cost allocation methods in managerial accounting. Before starting with cost allocation methods, let us know what cost allocation is. Direct costing, also known as variable costing method, and the second method is absorption costing income statements. We will restrict it to variable costing and absorption costing as the activity-based costing will be discussed in the coming sessions. The easy rest matrix, two types of matrices, standard and deluxe, the contribution margin income statement for the most recent year of the company and accompanying unit level data for the most recent year of operations is given. This table represents the method and has all the details you would need for further calculations. Let's take the first method we are going to discuss, which is the direct costing or variable costing method. As this format groups variable cost and fixed cost separately, that is called direct variable costing. It is an extension of the traditional method and it helps us know the inventory cost. The production volume in units is 18,000 for standard and 12,000 for deluxe, giving us the total as 30,000. The sales volume in units here is 17,000 for standard and 11,600 for deluxe, giving us the total to be this. Revenue will be found on the basis of sales and not on the basis of production. Therefore, it would be number of units sold multiplied by the selling price per unit for each type of mattress, giving us the total to be this. Now, the cost is divided into two components, that is the variable cost and fixed cost. The first, the variable cost is subtracted from the revenue. To find the variable cost of 17,000, we would multiply 17 to 295, which is the unit price of the direct material. This was found through the traditional method which we have already provided you here for your ease. Therefore, we would get 50,15,000 on multiplying 295 and 17,000 and 40,60,000 by multiplying 350 to 11,600. The same will be done for direct labor and the same way we will find the total direct labor cost. Similarly, we will take the unit level data for various marketing and sales and multiply it with the sales in volume. For example, that would be 24 into 17,000 to get the results for standard type of mattress. The point to be noted here is that we are taking the sales unit and not the production unit, which would give us the inventory later on. Now, revenue minus all the added variable cost will give us the contribution margin. The fixed costs are the manufacturing overhead, marketing and sales, and the administration costs. Adding all these three gives us the total fixed cost. And the fixed cost is subtracted from the total contribution margin to give us profit before taxes. Keep in mind that the fixed cost is subtracted from the total itself and not from the per unit data given. Now, we will do the inventory evaluation. Firstly, in inventory evaluation, we don't take the sales into consideration as it is taken on the production. And as we are just calculating the costs of the inventory and not calculating the profit, we don't take sales into consideration. The unit level direct materials were 295 and 350 for standard and deluxe respectively, and the direct labor was 75 and 150. We don't take marketing and sales cost here as these goods are not sold, therefore there is no point of taking marketing and sales costs into consideration. Adding these two will give us the inventory cost per unit. Multiplying the inventoriable cost per unit to the number of units inventory, which is basically the unsold goods, gives us the total value of inventory for each type of mattress and their addition gives us the total inventory cost. This was our first method. We would learn is the absorption costing income statement. An addition to this method from the previous method is that the product cost and the period costs instead of variable cost and fixed costs. Now, product costs are the costs that are directly attributed to the per unit of the product. In layman terms, we can say that it is the money spent in your factory for the production. So basically, more the number of units, more the product cost. Here, direct material, direct labor, and manufacturing overhead costs are the costs incurred in a factory. So, we would find direct material cost and direct labor cost exactly the way done in the earlier method. Manufacturing overhead is the new thing to be calculated here. Manufacturing overhead will be calculated on the basis of direct labor hours. In the last method, 50,40,000 was the total manufacturing overhead incurred. So the total manufacturing overhead will be divided by the total direct labor hours, that is 30 lakhs 15,000, which would give us 1.6. Now this 1.6 would be multiplied to 12,7,500 divided by 17,000, which would give us standards allocated overhead, and 1.6 into 17 lakh 40,000 divided by 11,600 would give us deluxe's overhead cost. Period costs are added to the total cost directly, giving us the profit before tax. Now, the unit level data would be found with just as we would take all the product costs, including the allocated overhead costs, multiplying the inventoriable cost per unit to the number of units in inventory would give us the total inventory. This was our second method, the absorption cost method. We use these methods firstly to compare the costs and see if the product is beneficial to us or is it incurring losses or not. Secondly, to know how to allocate the cost so as to maximize our profits. I hope this video helped you. Thank you.